I want to talk now specifically about the banking sector and what's going on there. To do so, I will refer occasionally to this book, Country and Political Risk, mainly, of course, in a shameless effort to promote the book because I edited it and it was published a couple weeks ago, but also because most of the 14 chapters in the book were contributed by country risk managers at various global banks. And so rather than hearing from me what's happening in country risk assessment and banking, you can hear it from them. So the big difference between the banking sector and any other sector when it comes to country and political risk is that they are required by regulation to manage and assess country and political risk. And you may hear a little bit more about this. I think Sarbanes-Oxley makes more general requirements about reporting. Is that correct in the corporate sector? And which is true and recent, a recent development. But in terms of requiring country risk assessment, that is a long-standing and a development fairly unique to the banking sector in that it started in roughly the 1980s. And now this is broadening out, as I think Lori will say, broadening out to the corporate sector more broadly. This is a manual from the Comptroller of the Currency, one of the great many institutions government institutions charged with regulating banks in the United States. Country risk is the risk that economic, social, and political conditions and events in a foreign country will affect an institution. By that they mean a bank. To manage this risk, banks must institute adequate systems and controls over their international activities. Key word there is must. It is not an option. A sound country risk management process includes a process for analyzing country risk, a country risk rating system, country exposure limits, and monitoring of country conditions. So banks have to have the capacity since the 1980s to assess country and political risk. And that is something that banks took very seriously. I can remember in the 1990s from the Bank of America World Information Services, you could get a country risk report. Now, I don't mean an investment research report. I mean an actual country risk report on any country you wanted around the world. I think they were updated every quarter, covered maybe 100 countries or so. But over time, banks became less concerned. Maybe that was overkill back in the day. But over time, banks became less concerned with this issue. They learned their lesson. They didn't lend so much to emerging market borrowers, especially not to a single borrower, as they had done in the case of Mexico. Emerging markets learned their lesson, especially after the Asian financial crisis. They didn't borrow so much. And so the country risk and political risk situation in banking seemed by and large to have been managed. There were very few banks suffering these losses. And as a result, these kind of assessment capabilities were dialed down a lot. I remember going to the office where the World Information Services reports were once produced, and it was a ghost town by the end of the 1990s. An entire floor used to be of country risk analysts, had a couple people on it by that point. I remember talking in the late 1990s to the head of country risk at one of the Wall Street investment banks, and he said, well, his staff was 4 people, and then it was 2 people, and then it was him working half-time. And his CEO said to him, you know, I don't need country risk analysis because you're just telling me that my risk limit for China risk is too high. And frankly, even if I believed you, we need to be in China. The shareholders would kill us if we wouldn't be in China. So we're going to be in China. So what am I paying you to do that kind of analysis for? Which, in light of what subsequently happened in the banking sector, is a little bit of a worrying conversation. But of course, it wasn't China that got them. In the end, it was the global financial crisis. As DJ pointed out, it was the Eurozone crisis. So in the end, it was advanced economy country risk that became, once again, a country risk threat and an existential threat to banks. And so now country and political risk is very much back on the menu. It is back as a very serious concern of banks. One company that Oxford Analytica works with said they are hiring not only back their original staff of 10 country risk analysts, they're going to expand further beyond that. So you're seeing a lot of emphasis, also a lot of emphasis from regulators about country risk. So that's a big trend, this trend towards country and political risk assessment in banking. and especially that this is happening in advanced economies. In addition, political risk specifically is getting to be a very major concern. This is a comment from Max Sheeler, who is the head of country risk management at UBS. Apart from the reemergence of sovereign risk, creditors and investors have also been reminded another important component of country risk, namely political risk. He talks about the Arab Spring, Ukraine crisis, Thailand. He says, these came as timely examples of how quickly and drastically the political environment can change with the significant adverse economic impacts accompanied by a deterioration in these countries' credit profile. Now, that comment should tell you something, which is that when a banker says political risk, they mean something slightly different. You know, when Lori talks about political risk, she's usually referring to the kind of insurable risks like sovereign default or exchange transfer risk, expropriation. But when a banker talks about political risk, they're talking about political events that may impact economics or drive credit risks. So it's a different type of risk, but geopolitics are increasingly important. And they're important for another reason as well. This is from Victoire de Groot, who is the head of country risk at HSBC. She says that, sorry, wrong quote. She says that country risk analysts have also broadened their approaches to political risk. This change has been spurred by the latest crises, during which time creditor and international institution perception of a country's governance, compliance with international rules, and general transparency became a key factor in acquiring necessary external support. In other words, surviving in today's global economy often means getting a bailout from somebody, and the quality of governance in a country has become a very important factor in whether a country receives a bailout. So that is another reason that bankers are looking increasingly at politics. Not just the case for emerging markets receiving a bailout from the IMF, but especially for Greece. Obviously, this is a huge concern and current concern for Greece, whether Greece's governance makes it possible to bail Greece out effectively. A very big concern now for the European Central Bank, Europe, and the other institutions involved in working out a bailout for Greece. So that's another reason why political risk is really important. Now, there's one last point I want to make about how country and political risk is changing. And this is a point about models and analysts. And I would say a big trend now is that analysts are kind of once again getting the upper hand. Now, there will be always country risk models that are used heavily, especially in the banking sector, and country and political risk models. In the book, some Italian academics introduce an early warning system model for sovereign risk crises in advanced economies, which they note have very different drivers from crises in emerging economies. Lori, I think, will talk about a model which I worked with her on as well, a VAPOR, which is a system that values political risk, and that is a model that based on catastrophe risk models and looks at geopolitical event risks and insurable types of political risks. There are also other impetuses towards models, other reasons why models are being used. Paul Domjan, who works for Rubini Global Economics, this is actually a competitor to Oxford Economics, a company I work with closely, so I don't have to say anything nice about Paul, but he does make a couple very good points. One is that regulatory changes in the financial services industry requiring firms to take a more model-based and quantitative approach to measuring risk. This is very true and looks unlikely to change anytime soon, despite the changes since the global financial crisis. He also notes that organizational structures of country risk teams tend to drive a preference for quantification. Since the financial crisis, many organizations have been developing or expanding their country risk functions, as I said. These functions draw typically on personnel from or are extensions of existing credit risk teams. As a result, they are attempting to apply quantitative frameworks similar to those used for probability of default in credit risk. In other words, use the tools that you know. And people, when they're moved over from credit risk to managing country risk, they bring with them the approaches that they know, and those approaches are quantitative approaches. But of course, there was a big problem during the global financial crisis. This is back to Victoire, the head of country risk at HSBC. One may wonder whether reliance on mathematical approaches to risk assessment remain prudent. The significant limitations of model-based risk management techniques were exposed under a harsh light in the global financial crisis. Its poor track record has led to many advocating the need for a more eclectic approach to economic analysis. So these models, the mathematization of economics, did not help predict the emergence of crises nor the potential consequences or derived issues. We're sympathetic to such views. So I should say, this is a problem. So models don't necessarily work. They didn't work, especially during the global financial crisis, and they didn't work very well. Country risk models did not work very well during the Eurozone crisis. And what's happening, I think, in response is not that models are being abandoned, but that the analyst is kind of becoming the last line of defense. Victoria writes, I'm sympathetic to such views. The mathematical techniques we suggest in this chapter are in fact developed in such a way to be supportive of a more holistic approach to risk assessment. So in other words, the country risk analyst becomes a primary driver of the assessment of country and political risk. They're using models as tools. Victoria, in her chapter, advocates early warning system models and structural models of credit risk being used together. So, they're using a model as tool. Obviously, the model can't make the final decision, or has in the past, in recent years, made the final decision very badly on country risk management, but it can continue to be an extremely useful tool. And I think those three trends that I've mentioned here are tied together. One, bringing on more country risk staff. The other being more of a focus on political risk, and political risk is really hard to address with models. And three, bringing the analyst back to be in a decision-making position on country risk. Those three trends are all kind of part of each other. They're not the same thing, but they're sort of related, and they signify a really big change in the profession in banking. Thank you.